$60 a year. That is the cheapest path to a better credit score in 2026. And most people are spending 3 times that on the wrong product. Credit builder loans are not equal. One builds your score and your savings account simultaneously. One is built for the person who needs a 10-year installment history. One costs $5 a month and works in a completely different way that almost nobody explains correctly. By the end of this video, you will know which product fits your exact situation and which ones you can skip. Here is what nobody tells you before you sign up for a credit builder loan. You are paying money, real money, every single month, and you do not get that money back immediately. Some people treat it like a savings account. It is not. It is a financial tool, and tools only work when you pick the right one for the job. The second problem, the wrong product for your situation does almost nothing to your score. You spend a year making on-time payments, and your score moves 11 points. That is not a product failure. That is a mismatch. The third problem, every credit builder loan website sounds identical. Build credit, save money, no hard pull. They all say it. The differences are in the fee disclosures, the bureau reporting, and the account type. And that is exactly what this video covers. We analyzed verified product terms and fee disclosures directly from each issuer's website, alongside community feedback from RC Credit and r/Personal Finance, 2 of the most active personal finance communities online, with a combined multi-million member base. The 3 products in this video, Self, Credit Strong, and Kikoff, represent the 3 structurally distinct approaches to credit building in 2026. They are not competing for the same customer. By the end of this breakdown, you will know exactly which category you fall into. The evaluation framework, bureau reporting coverage, total cost of ownership, account type added to your file, timeline to visible score impact, and the specific profile each product serves best. Tier 1 Self-Credit Builder account. Best for no credit history or thin file. You want installment reporting plus a path to a secured visa. Here is the verdict on Self first. It is the most complete entry-level credit building product available right now because it does 2 things simultaneously. It builds your credit file and it builds a savings balance you receive at the end of the term. Here is how it works mechanically. You make fixed monthly payments into a certificate of deposit. Self reports those payments to all 3 bureaus, Equifax, Experian, and TransUnion. At the end of your term, you receive the principal you paid in minus fees. 3 specific data points you need to know. Data point 1, account type. Self adds an installment loan to your credit file. This matters because payment history is 35% of your FICO score, and credit mix, having both revolving and installment accounts, is a separate factor that thin file borrowers are often missing entirely. Data point 2, cost structure. On a common plan, $25 per month for 24 months, you are putting $600 into savings. The net cost after fees and the interest the CD earns is approximately $89. That is the price of the installment account and 24 months of on-time payment history being added to your file. Data point 3, the Self Visa upgrade path. After you have accumulated $100 or more in savings and made at least 3 on-time payments, Self offers a secured Visa credit card backed by your existing savings balance. No additional deposit required. This is significant. It means you can add a revolving account to your file without pulling a separate deposit from your checking account. Who Self is for? Someone with no credit history, a thin file, or recovering from missed payments who can commit to a fixed monthly payment for 12 to 24 months. If you can afford $25 to $48 a month and you want all 3 bureaus reporting, Self is the clearest starting point. Who should skip Self? someone who already has an installment loan on their file and simply needs to improve utilization. There are cheaper ways to do that. Tier 2, credit strong. Best for, you want a longer installment history or a higher credit limit reporting to your file. Credit Strong is owned by Austin Capital Bank, which is FDIC insured. The structure is similar to Self. You make payments, build savings, receive your principal back at the end minus fees. But the differentiators matter if you are in a specific situation. 3 data points. Data point 1, term length. Credit Strong offers terms up to 120 months, 10 years. Self's terms are shorter. If your credit building strategy involves aging a long installment account, Credit Strong's longer terms give you an option Self does not. Data point 2, loan amounts. Credit Strong's plans can report higher credit limits to the bureaus than many Self plans. A higher reported loan amount on an installment account changes how lenders read your file. It signals you can manage larger obligations. Data point 3, no hard credit pull. Multiple Credit Strong plans require no hard inquiry. For someone who has already taken a few hard pulls recently, this matters. Credit Strong also has a revolving product called Revolve, which adds a revolving account instead of an installment account. Fees vary by plan. Both products report to all 3 bureaus. Who Credit Strong is for? Someone who already has basic credit history started and wants to build a longer, larger installment account on their file. Also ideal for the strategic rebuilder who is managing hard inquiries carefully. Who should skip Credit Strong? Someone just starting from zero with a thin file. For that person, Self's simpler entry point and Visa upgrade path is the better first step. Before we get to Kikoff, I put together a free first chapter of the 500 to 700 roadmap. It is a step-by-step guide to moving your score from a 500 to a 700, including which products to open in what order and why the sequence matters. The link is cardsmadesimple.com/rebuild. Free, no card required, takes 60 seconds to grab. Tier 3, Kikoff. Best for, you already have some credit history and want the cheapest way to improve your utilization ratio. Kikoff is structurally different from Self and Credit Strong, and that distinction is the entire point of this tier. Kikoff is not a savings product. You do not get money back at the end. It is a $750 revolving credit line. Think of it like a credit card. And it charges a $5 monthly membership fee. You can only spend that credit at Kikoff's own online store. 3 data points. Data point 1, cost, $5 per month, $60 per year. That is the cheapest credit builder product in this comparison by a significant margin. Data point 2, what it actually improves. Kikoff reports a $750 revolving credit line, which improves your credit utilization ratio, a factor that is approximately 30% of your FICO score. If you have a $500 credit card with a $400 balance, adding a $750 Kikoff line with a $0 balance immediately lowers your overall utilization. Data point 3, bureau reporting. Kikoff currently reports to Experian and Equifax. This is the key limitation compared to Self and Credit Strong. If your lender pulls TransUnion only, a Kikoff account may not show. What Kikoff does not do: it does not add an installment loan to your file. It does not build your savings. It is purely a low-cost revolving utilization tool. Who Kikoff is for? Someone who already has an installment account open, already has some payment history, and needs the cheapest possible way to add available revolving credit and lower their utilization. Also works as a supplemental product alongside Self. Run both simultaneously, if budget allows. Who should skip Kikoff? Someone with zero credit history who needs to build a file from scratch. Kikoff alone will not build the installment history that most lenders want to see. Here is the verdict by situation. No hedging. If you have no credit history or a thin file and need to build from zero, self. $25 per month. All 3 bureaus reporting, installment account added, and you end the term with cash back in your pocket. The Self Visa upgrade path means one product gets you both an installment account and a revolving account without 2 separate applications. If you have some history and want to maximize the installment account length and size on your file, Credit Strong. Longer terms, higher reported loan amounts, no hard pull on most plans. This is the tier up from Self once you have your basics established. If you already have installment history and payment history, and you just need to lower utilization at the lowest possible cost, Kikoff. $5 a month, no hard pull, $750 revolving line added. The score that matters is the one in 12 months. The people who start today with the right product for their file are the ones who qualify for the cards with the actual rewards programs in 2027. The people who wait or pick the wrong product start that clock over. That covers credit builder loans. But there is one question I have not answered yet. Once your score has moved, which secured card do you apply for first? Not every secured card is worth opening. Some have fees that eat your security deposit before you get any benefit. And one of the most recommended options is no longer accepting applications as of 2026. That breakdown is next. Subscribe and you will get the secured card verdict the day it drops. The free first chapter of the 500 to 700 roadmap is at cardsmadesimple.com/rebuild. It covers which products to open, in what order, and how to time each application for maximum score impact. Link is in the description. Financial disclaimer. This content is for informational purposes only and is not financial advice. Credit card terms, rates, and offers change frequently. Verify all